So in today's video, I want to talk about the key takeaways from Analyst Day. I also want to talk about the number one thing, the number one red flag for dividend cuts. And lastly, I want to go over an easy peasy framework that you can use if you're deciding to buy more of Algonquin Power or deciding to sell Algonquin Power. So if you're interested in Algonquin Power, because the dividend yield is now like close to 10%, which makes it pretty enticing for income investors, or you're like, you're not sure if you should sell or to hold, then you definitely want to watch today's video. It's probably not surprising that Algonquin Power did a dividend cut. I mean, I've been talking about it since last year about all the red flags about Algonquin Power when I was revealing my dividend stock portfolio. So what did I see from Analyst Day? So the first thing is it's unfortunate that it did do a 40% dividend cut, which is actually more than what I expected. Number two, it is selling its assets, which is a good thing because it wants to put itself in the best financial position. It's like you, if your salary just went up a little bit above inflation, but your mortgage payments just keep going up and up because you're in a variable rate mortgage, your expenses are getting higher and you got to trim somewhere because you're prioritizing maybe that Disney subscription and Netflix subscription doesn't look that great anymore. Or maybe you're looking to not go on that extra vacation that you always wanted to this year. So you're going to trim back some of your expenses because paying your mortgage is probably pretty important to you. So with Algonquin Power, selling some of its assets to raise money and cut its dividend is trying to put itself in a better financial position. Now, number three is heartbreaking. It's cutting its dividend reinvestment program, which is terrible because I was investing in Algonquin Power stocks to be part of the dividend reinvestment program to buy more shares and then to own more of the dividends. Unfortunately, Algonquin Power is cutting its dividend reinvestment program, which is sad. Lastly is Algonquin Power is reducing its earnings estimate because it's been acquiring more debt, has to cut expenses, and therefore it's not taking in as much profits. So all these signs show that Algonquin Power is definitely putting itself in a better financial position. If you're wondering, is the stock cheap because it's dropped 45%? So let's look at that right now. So the earnings estimate, the forward guidance is like 55 cents to 61 cents per share. If you look at its price per earnings, which is the stock price relative to its earnings, it gives you about 12.5 to 12.75, depending on obviously the time of the day, what the stock price is. So when I look at a metric of 12.5, 12.75, it's telling me if I'm a bargain hunter, which I am, and I want to get deep value, then I want a stock that if it has 12.5, I'm expecting the earnings estimate can grow by 12.5% year over year in order to make it cheap because I'm looking at its price per earnings relative to its growth rate, otherwise known as the PEG ratio. And a good rule of thumb, anything less than 1 is looking pretty undervalued. So if I were looking at Algonquin Power's growth rate for the next few years, I highly doubt it's going to grow 12.5% year over year for the next few years. In fact, it's probably just going to be flat. It's probably might even drop because it's trying to put itself in a better financial position, which is reducing its debt, paying down its debt. It's going to do whatever it can, just like us with our higher mortgage payments. We're going to do whatever we can to trim back other expenses so that we can still continue to pay the mortgage payment. So for me, I don't think the stock is actually that cheap. It's fair value, maybe, or it could be deemed expensive, and depending on what you think the growth rate for its earnings. So what's the number one thing I look for to determine if its dividends is safe? The one thing you absolutely want to look for when you're looking at dividend stocks, dividend growth stocks, is look at the fundamentals. And the one metric you could absolutely look for just to check, is it going to cut its dividend, is look at the dividend payout ratio. The dividend payout ratio is simply telling you how much of its profits is the company paying out to its shareholders. So if a payout ratio is like 90%, over 100%, you know that is super unsustainable because how could a company pay 90 to over 100% of its profits back to its shareholders year over year and still increase its dividends? Unless you're a real estate investment trust, they are actually supposed to pay most of its profits back to you. But if you're a regular company like a bank, utility company, you're not supposed to have a payout ratio over 100%. And Algonquin Power, unfortunately, earlier or later last year, I did notice this payout ratio was getting in a point where I was feeling super uncomfortable. So please, in a high inflationary, high interest environment, when we have a potential recession, please look for quality dividend stocks. Look at the fundamentals. Look at that payout ratio. If you want to see where you can find a payout ratio, you could go to Yahoo Finance, you could go to QuickFS, you could go to Simply Wall Street. All three resources show the dividend payout ratio. Now, I know some of you are probably going to think, well, there was a metric called the adjusted funds from its operations, which is the AFFO, which is another metric to determine can it afford to pay out its dividend. And if you had used that metric, you might think Algonquin Power was in a decent position to pay its dividends. But AFFO is a tricky metric. It's a tricky accounting metric. So this is the part where I really recommend use the standard earnings per share payout ratio, the cash flow payout ratio. Just make sure you don't go over 80%. Should make you uncomfortable. Now, as a huge caveat, I am not a financial advisor. I'm only doing this for entertainment purposes only. I love sharing my investing knowledge, but I highly recommend, please always do your own due diligence. Now that I got that out of the way, let's get into what I really want to talk about, which is the easy peasy framework you can use if you're deciding what to do with your Algonquin Power positions, or if you're looking to buy more Algonquin Power position. So if you don't own any position in Algonquin Power and you're super enticed by the 10% yield because you think it's cheap, I hope that you've been watching this video and realize that I said I actually don't think it is that cheap relative to its growth rate. So if I were in your position, I was just really wanting to just buy Algonquin Power because it's dropped so much, I would just do it knowing that the stock price isn't actually that cheap relative to how much it's earning. I would go in and only do it with a very small position just to scratch the surface. I believe that there's many more companies in Canada or utility companies in the world that have less risk involved. Now, when it comes to, say, you own Algonquin Power and you actually rely on the dividends to pay for your day-to-day expenses, and you already made money in Algonquin Power, if I were in that position, I personally would reduce my Algonquin Power position because, I need it. I need the money, right? I start rebalancing my portfolio and look at other companies that have less risk in the utility space. Now, if you're in a position where you own Algonquin Power and you're left holding the bag and you're wondering what to do with it, well, for me personally, I don't rely on this coming from Algonquin Power. But what I do rely on is the fact that the dividends grow year after year after year. Because Algonquin Power cut its dividend reinvestment program, which means it's not only not growing its dividends every year, but it's already cut its dividend reinvestment program, which means that it's making it more expensive for me to buy more shares of the company because it's not commission free anymore and it's not automatic. Those are two things that makes me really rethink my position. In fact, I already sold a portion of my Algonquin Power stocks earlier last year. I didn't sell it at a gain. I sold it at a loss, and I used it as a tax loss harvesting method. And if you want to learn more about tax loss harvesting and how to get your taxes to zero, you can watch this video up here. But for me, I'm looking at Algonquin Power and I saw just more red flags. Now, I would say what it's doing, which is reducing its debt, cutting its dividend, is actually putting itself in a much better financial position. But I'm a dividend growth investor. So when I look at my goals, I want the dividends to grow year after year to build that dividend snowball so that my income from dividends grow 10 years, like double what it is today. But because Algonquin Power doesn't fit that model, that's why I'm looking to rebalance my portfolio. So I would encourage you to make your decisions working backwards from your end goals. So for me, I'm looking to rebalance my portfolio. I'm looking at other positions in the Canadian space. There are so many. There are lots of opportunities. When it's a bear market, a lot of things have dropped. A lot of things are much more affordable relative to its growth rate. So this is a time to actually be greedy and start buying more and more positions. But I would really encourage you in a high interest environment, in a rocky economy, in an area where there could be recession, I would just be very careful and be very diligent about picking high quality companies with strong fundamentals. And you want to learn more about how to evaluate fundamentals, look at companies, even look at real estate, check out these playlists out here. Anyways, I hope you found this video super helpful. I hope to see you in the next video. Bye.